Consumer prices just fell for the first time in 5 years, but Wall Street isn't celebrating. Why? Because Trump's new tariffs on Chinese goods could reverse this entire trend overnight. In this video, I'm breaking down exactly what happened with March's surprising CPI drop, why economists are so nervous about the tariff situation, and what it all means for your money. This perfect storm could determine whether we get rate cuts or renewed inflation, and your investment strategy needs to adapt either way. Have you ever wondered what would happen if prices actually started going down instead of up? Well, it just happened. March's consumer price index shocked economists with something that they haven't seen in nearly 5 years, an actual decline in prices. We're talking about a 0.1% drop when virtually every analyst was expecting another increase. Not just any increase, but specifically a 0.1% rise. So this complete reversal caught everyone off guard. Think about that for a second. For half a decade, we've been conditioned to expect prices to rise month after month, and the only question was usually how much they would rise, not will they. So when the numbers came in showing that overall prices had actually decreased, it sent ripples through financial markets. This wasn't just a minor statistical fluctuation, it represented a legitimate break in the inflation pattern that's been squeezing consumers since the start of the pandemic. And what's particularly interesting is what drove this unexpected price drop. Energy costs led the charge downward, with gasoline prices plunging by 6.3% in just 1 month. That's a massive move for such a critical consumer expense. Used car prices also contributed, falling 0.7% after their dramatic pandemic-era surge. These two categories carry significant weight in the overall index and helped push the needle into negative territory for the first time in years. But before you celebrate too much, the story gets more nuanced when we look at other categories. Food prices still climbing, up 0.4% overall, and grocery store prices specifically jumped 0.5%, with egg prices skyrocketing nearly 6% in a single month. And housing costs continued their relentless march upward, with owners equivalent rent housing another 0.4%. So while the headline numbers looks encouraging, the daily necessities many Americans spend most of their budget on haven't necessarily gotten any cheaper. And when we zoom out to look at the annual rate, the picture still shows improvement. Year over year, inflation cooled to 2.4% in March, down significantly from February's 2.8%. That's remarkably close to the Federal Reserve's 2% target, closer than many analysts thought we'd get this quickly. The core inflation rate, which strips out volatile food and energy, tells a similar story of gradual improvement, rising just 0.1% for the month versus February's 0.2% increase. And what makes this report particularly significant is that it suggests we might be witnessing a fundamental shift in consumer demand patterns. Because after years of seemingly insatiable spending, fueled first by pandemic stimulus and later by wage growth, Americans might finally be pulling back, combined with improving supply chains. This could be the recipe for sustained price stability that the Fed has been hoping for. And financial markets certainly thought so, because within minutes of the CPI release, traders dramatically shifted their bets on future Fed policy. The probability of a rate cut at the May meeting nearly quadrupled, jumping from just 10% to 37% in a matter of weeks. Some analysts even begun speculating about the potential for a full percentage point in cuts this year, a dramatic shift from earlier, more conservative predictions. And this market reaction was visible across multiple financial instruments. The dollar weakened against other major currencies, dropping 1.2% on the index, while Treasury yields initially fell as investors processed the news, though the benchmark 10-year later climbed back to 4.35%. The 2-year yield, more sensitive to the Fed policy expectations, settled lower at 3.86. And these movements reflect a market rapidly recalibrating to the possibility that inflation might be further along than previously thought. And for consumers and investors alike, this data represents the first concrete evidence that inflation might actually be ending rather than just slowing down. And that's a profound difference between prices are rising more slowly and prices are actually falling. And the psychological impact on consumer confidence and spending behavior could amplify the disinflationary trend, creating a virtuous cycle that further cools price pressures. And so now the Fed finds itself in an interesting position. You see, for months, officials have been cautious about declaring victory, repeatedly emphasizing their commitment to returning inflation to the 2% target. And this data suddenly gives them more flexibility, because with price pressures easing faster than expected and some areas of the economy showing signs of cooling, the case for maintaining high interest rates weakens considerably. But before investors celebrate too much, there's a major complication that could reverse all this progress overnight. The positive inflation data arrives just as new threats loom on the horizon, particularly around international trade. And the timing couldn't be more challenging, as potential tariff increases on Chinese imports threaten to introduce an entirely new inflation dynamic into the economy. And if you're enjoying this content so far, please consider subscribing to the channel and hitting the like button for the algorithm. It's a free way you can show support if you find this content enjoyable, and it is much appreciated. Thanks for doing that. Now, back to the content. And the market's celebration over cooling inflation might be dangerously premature. Have you ever considered what happens when trade policy and monetary policy collide head-on? Well, with Chinese goods filling American homes from coast to coast, these proposed tariffs aren't just a political bargaining chip, they're potentially the single most significant inflation wildcard we've seen since the supply chain crisis. And President Trump's announcement about increasing tariffs on Chinese imports couldn't have come at a more complicated moment. Just as we're seeing the first real signs that inflation might be returning to normal levels, this curveball threatens to reshuffle the entire economic deck, because these aren't small adjustments to obscure product categories either. We're talking about substantial new taxes on products from America's largest import partner on things we use every day, and this is the very country that stocks the shelves at nearly every major retailer across the nation. Now, what makes this situation particularly challenging is that economic experts can't even agree on how serious the inflationary impact might be. Christopher Rupke warns that the good news of an inflation soft print in March needs to be taken with a grain of salt, suggesting the trade war with China could reignite price pressures that had just begun to cool. And this perspective paints a concerning picture for consumers who've barely had time to catch their breath after years of painful price increases. But then you have completely contradictory analysis from organizations like the Economic Policy Institute, which presents a much less alarming view. Their research indicates that the bulk of existing tariffs were actually in place well before inflation accelerated in March of 2021, and this timeline disconnect challenges the popular narrative that tariffs were a primary driver of inflation we've been experiencing. Their number crunching suggests that removing all tariffs imposed since 2016 would only deliver a one-time 0.3 percentage point reduction in consumer prices, which is far less dramatic than many fear. So who's right? The answer might determine whether your portfolio grows or shrinks over the coming months. And the truth is, Federal Reserve officials aren't taking any chances. They're carefully monitoring how these tariffs might complicate the inflation battle. Dallas Fed President Lori Logan has specifically emphasized the importance of preventing tariff-related price increases from fostering more persistent inflation, and this concern speaks volumes about what keeps Fed officials up at night: the possibility that just as we're gaining ground in the inflation fight, a whole new front could open up. And the minutes from the Fed's March meeting reveal that policymakers were already anticipating this problem, noting that participants judged that inflation was likely to be boosted this year by the effects of higher tariffs, and that their business contacts were already reporting increases in costs, possibly in anticipation of rising tariffs. And this suggests that businesses aren't waiting for tariffs to actually hit, they're preparing now, which could accelerate price increases even before policies officially change. What most market commentators overlook is that the ultimate impact hinges on two critical factors. First, how quickly will businesses pass increased costs to you, the consumer? Some companies might absorb tariff costs temporarily to maintain market share, while others might immediately raise prices. And second, will long-term inflation expectations remain well anchored? Because if consumers and businesses start expecting persistently higher inflation because of tariffs, it could become a self-fulfilling prophecy as people adjust their spending and pricing behavior accordingly. And the unfortunate timing of all of this creates an impossible situation for the Federal Reserve. They were finally positioning for potential interest rate cuts after months of restrictive monetary policy. Now they're caught in brutal crossroads. Should they cut rates to support economic growth if tariffs slow business activity, or should they maintain higher rates to counter potential tariff-induced inflation? And the Minneapolis Fed President Neel Kashkari bluntly acknowledged this dilemma, stating that the Fed could cut rates if tariffs cause job losses or raise them if tariffs trigger inflation. But the catch, as Kashkari noted, adjusting policy either way will require clear data signals that might take months to materialize, leaving markets in an extended period of uncertainty. And this policy uncertainty is already impacting business and consumer sentiment, potentially weighing on investment decisions, spending patterns, as well as hiring plans. Companies hesitant about the future tend to delay expansion and freeze hiring, which is exactly what the economy does not need right now. And as economic uncertainty paralyzes business decisions, the Federal Reserve finds itself trapped in a high-stakes chess match with no clear winning move. They were positioning for victory laps with the rate cuts this year, but now market probabilities have turned into a wild roller coaster, with the chances of a May rate cut surging from just 10% to 37% in a mere 2 weeks. This dramatic shift reflects the market's immediate reaction to contradictory signals, cooling inflation numbers on one side and looming tariff threats on the other. The Fed's dilemma is unprecedented in recent history. For the first time since the financial crisis, they face two equally dangerous scenarios: cutting rates too soon if tariffs spark inflation, or keeping rates too high if economic activity stalls. Minneapolis Fed President Neel Kashkari also acknowledged this brutal trade-off directly, noting that they might need to cut rates if tariffs lead to job losses or raise them if tariffs trigger a new inflation wave. And while investors had already penciled in a full percentage point of rate cuts for 2025, the tariff situation has completely scrambled the economic equation. Financial markets immediately began repricing their expectations, trying to calculate which threat will ultimately drive Fed policy. And this uncertainty is creating volatility across every major asset class as investors struggle to position their portfolios appropriately. In San Francisco, Fed President Mary Daly has taken a notably cautious approach, stating publicly that officials are still carefully evaluating the net effects of Trump's policies. In her own words, the Fed is analyzing how some elements might weigh on economic activity, while others, such as deregulation and tax cuts, could induce more demand. Daly emphasized avoiding hasty conclusions during this period of uncertainty, which is a stark contrast to the confident messaging that typically precedes rate adjustments. And this cautious, data-dependent approach makes perfect sense, because the potential economic impacts of tariffs are multifaceted and complex, possibly slowing growth through reduced trade while simultaneously pushing prices higher through supply chain disruptions. The Fed must carefully weigh these opposing forces before committing to any policy direction, and financial markets have responded to this uncertainty with significant volatility. You see, Treasury yields initially dropped on expectations of economic weakness, then climbed back up as inflation concerns resurfaced. The dollar weakened against major currencies as international investors reassessed America's economic outlook, and stock futures have swung dramatically between gains and losses, sometimes within the same trading day. And Jake Dollarhide, CEO of Longbow Asset Management, captured the market's confusion perfectly when he said the market is uncertain about how to position itself, giving conflicting signals from inflation data as well as tariffs. He suggested that if cooler heads prevail, with tariffs potentially being paused while inflation continues trending lower, it could finally give investors the green light they've been waiting for. But that if is doing a lot of heavy lifting. The reality is that investors now face an extended waiting game, caught between positioning for rate cuts that could supercharge asset prices or preparing for renewed inflation pressures that might force the Fed to maintain higher rates. And this uncertainty creates both significant risks and potential opportunities for investors who understand the dynamics at play. For everyday investors, this situation creates challenging questions. Should you position for a Fed that prioritizes fighting recession with aggressive rate cuts, or should you expect rates to remain higher as the Fed battles tariff-induced inflation? The answer likely depends on which economic force ultimately proves stronger: the cooling demand we're seeing in recent data, or the potential disinflationary impact of new trade barriers. The volatility we're witnessing in financial markets isn't just noise, it's the direct result of genuine uncertainty about how these competing forces will play out. Investors who can navigate these choppy waters and accurately anticipate the Fed's response will find opportunities for significant gains, while those who position incorrectly could face substantial losses. And what makes the situation particularly challenging is that traditional economic models offer limited guidance. Most existing economic research examines either inflation fighting or recession prevention, not the complex interaction between tariffs, inflation expectations, as well as monetary policy that we're currently witnessing. This means that the Fed itself is navigating uncharted waters, forced to make policy decisions with imperfect information and conflicting signals. And for the average investor, this environment requires a different approach than the simple buy the dip strategy that has worked so well during the easy money era. Portfolio diversification, careful sector selection, as well as hedges, and maintaining some dry powder for opportunities become even more critical when the economic outlook is this uncertain. The market is likely to overact in both directions as new information emerges, which will create potential entry points for prepared investors. The bottom line is that we're at a critical inflection point. The March CPI data gave us our first glimpse of potentially cooling inflation, but Trump's tariff plans could erase these gains overnight. As Max Wasserman of Miramar Capital bluntly put it, these numbers are meaningless. It's what hasn't been taken into account, i.e. the fact of tariffs. Your investment strategy needs flexibility in this environment, because if inflation stays tamed and trade tensions erase, we could see what Peter Cardillo calls a Trump reversal rally. But if tariffs ignite price pressures while growth slows, caution becomes essential. And the Fed's response, according to Minneapolis Fed President Kashkari, will depend entirely on which threat materializes first.